Let me explain inflation in the simplest way possible. 5 years ago, $100 could get you a short weekend getaway. Today, $100 feels like a parking fee and makes you feel terrible. Same money, less happiness. And no, it's not just you being dramatic. Everything really is getting more expensive. The question is why? If you've ever thought, why does everything cost more now? Why does my paycheck feel smaller? Or why does the economy feel broken? You're asking the right questions. Because this isn't random. There are real forces behind rising prices, such as inflation, money printing, supply and demand, corporate pricing power, and economic cycles. And understanding these isn't just interesting. It's critical for investing, wealth building, risk management, and protecting your financial future. Because if you don't understand why things are expensive, you won't understand how to stay ahead. Let's start with the word everyone throws around, inflation. Inflation simply means your money buys less over time. Well, that's it. Same $1. Fewer things. Now here's the part most people don't talk about. Inflation is not just prices going up. It's also the value of money going down. Think of it like this: if everyone suddenly has double the money, would things stay the same price? No. If you have double the money, would you buy more? Of course you would. When everyone is buying more, but companies are not producing more, they would have to increase prices to deter people who doesn't really care about the product. So only people who really want it would buy it. For example, if a TV is selling for $500 and companies are not producing more, in order to accommodate people who really want to buy it, they increase the TV to $1,000. This way they filter out people who really want to buy a new TV, as opposed to people who don't really care for one, but since they have more money, why not? On the flip side, if you didn't buy the TV and still holding onto $500 that used to be able to buy one, your $500 just lost value. Now your $500 buys only half a television. So when people say everything is getting expensive, they are also saying money is getting weaker. That is very important in understanding financial psychology. Now let's talk about the part nobody explains clearly. Where does all this extra money come from? Governments and central banks can increase the money supply. Sometimes they do this to stimulate the economy, prevent recessions, or support financial systems. Sounds good, right? But here's the trade-off. More money in the system means lower purchasing power per dollar. It's like adding water to soup. You have more soup but less flavor. This is why after major economic events, you often see rising asset prices, rising cost of living, and a widening gap between rich and poor. Because the rich ones invest in the market, and stock prices go up to reflect companies who have charged more during inflationary period. And investors make money since they own a tiny piece of that business through owning stocks. But for those who didn't invest and still holding on to cash, their cash just lost value and now could buy only half a TV in the earlier example. This is why investing becomes critical. It enables you to rise with the market. If you're only holding cash during inflation, your money is losing buying power. You're slowly losing quietly and consistently. In order to understand inflation and money losing power, let's talk about basic economics. Supply and demand. If demand goes up and supply stays the same, prices go up. If supply drops and demand stays high, prices go up. If both happen at the same time, prices really go up. This is exactly what we've seen in recent years. Such as the housing market with supply shortages, supply chain disruption that hinders productions, or increase in consumer demand when production didn't or couldn't go up. All pushing prices higher. Here's the key insight: prices are not just about cost. They are about pressure that could come from the external environment. Are there global events that prevents companies from producing, so you have limited supply but demand remains high? Are there natural disasters that ruin raw materials which prevent companies from producing? There are pressure everywhere and they are unpredictable. Now let's talk about something a little uncomfortable. When costs go up, companies raise prices. That makes sense. But sometimes they raise prices more than necessary. Why? Because they can. This is called pricing power. That means the company has a group of loyal customers. These customers are less sensitive to prices and would buy the products even when they raise prices. For example, don't you feel like no matter how much Apple raised their prices, people still buy them? That's pricing power. They can increase prices without losing customers. How do we know that? Because the stock market tells us. Investors like companies that continue to perform no matter how the economy is doing. It is the kind of companies or investments they like for long term that can weather through economy cycles, and they maintain profits during inflation. Investors pay attention to business quality and like companies that handle inflation through economic cycles. Here is where things get personal. Your income. For most people, wages don't rise as fast as prices. Even if you're making more money, you feel poorer. This creates financial stress and frustration. And it changes behavior. People spend less, people save less, and people feel stuck. This is a major part of financial psychology. Because when people feel pressure, they make worse financial decisions. They might stop investing, panic sell, or avoid the stock market entirely, which actually makes things worse in the long term. The economy goes through cycles including expansion, peak, contraction, and recovery. Inflation tends to rise during expansion. And central banks often respond by raising interest rates. The purpose of raising interest rates is to slow down spending, reduce borrowing, and cool down inflation. Remember supply and demand. When people slow down spending, that means they buy less, then there would be less people pushing prices up, therefore help ease inflation. Unfortunately, on the flip side, they also slow down economic growth and impact the stock market. The stock market could be volatile during economic challenging times because people are adjusting to the economy. The worst thing is people panic and worry that everything is falling, so they panic sell. There are opportunists that jump in to buy when they see panic sellers selling at deep discounts. Because there are a lot of uncertainties in the external environment, and the stock market is a reflection of what's going on. Therefore, you could see the stock market with wide swings during uncertain economic times. Here's the important part: these are normal. They are economic cycles. They've happened before, and they will happen again. Now you might be thinking, if everything is expensive, how does investing still work? Great question. Because despite inflation, the stock market tends to rise over the long term. Why? Because companies adapt. They increase prices, they make more by selling the same amount of goods. They improve efficiency, they make more by reducing the cost of producing those goods. They innovate, they make new products to make you want them, then buy them. Overall, these will help companies grow and increase revenue. While inflation hurts cash, and common people now buy less with the same amount of money, it can benefit businesses. This is why long-term investing is so powerful. You're not just holding money. You're owning assets that grow with the economy without running the business yourself. So how do you fight inflation? When prices go up, what should you do? Number 1, invest, don't just save. Saving money is important. But saving alone is not enough. Because inflation reduces purchasing power. Investing helps your money grow over time. The United States has traditionally targeted inflation rate to be around 2% annually. That means if you just save and put money under your mattress, your money will lose buying power every year. If inflation stays at 2%, your money needs to grow at least 2% to keep up with the buying power. If your money can grow at 3% per year, you are a little bit ahead. Number 2, focus on long-term investing. While in the short term, market movements tend to be volatile and unpredictable. But over long periods, markets tend to grow. This is where wealth building happens. Number 3, diversify your portfolio. For most of us, a strong portfolio strategy could include stocks and index funds. Index funds contain a variety of companies that can weather through economy cycles. You can also add real assets to your portfolio as well. Real assets are assets that are tangible, you can touch them, and they produce value such as a house, a piece of land, a gold bar. Diversification helps manage risk, because owning a variety of investments help to spread out the risk. Number 4, understand risk management. Every investment carries risk. The goal is not to eliminate risk, but to manage it. That means manage the risk to a level that you can handle. That level of risk tolerance is different for everybody. Some people can handle more risk, and some people handle less risk. For people who can handle more risk, it means they can handle stock prices having wider swings up or down. For people who prefer lower risk, it means they prefer investment that are less volatile. In order to manage the risk of your investments, avoid overconcentration. That means putting a lot of money in one stock. Avoid emotional decisions. That means don't get into panic mode when everyone is selling. Also, don't chase trends, because investment is a long-term strategy. Don't put all your eggs in one basket or let your emotions drive your investment decisions. Stay calm through economic cycles and weather through the storms. It's not easy during downtimes, but in the long run, your portfolio will grow. Here's one of the biggest mistakes: doing nothing. When people feel overwhelmed, they freeze. They don't invest, don't learn, and don't adapt. Meanwhile, inflation keeps moving. Prices keep rising. And time keeps passing. Another one you often hear is "let's wait and see." For example, housing prices go through its up and down cycles. First-time home buyers are often overwhelmed. People want to wait and see if prices would drop. When prices dropped, they want to see if prices would drop more, and then keep waiting, hoping it would drop more. Eventually, when the market rebounds, prices shoot up faster than they were prepared for. Then regret kicks in. If I didn't buy when it was $200,000, I can't buy now that it went up 20% to $240,000. Let's wait and see. This cycle keeps repeating. 20 years later, the same house becomes $350,000, $400,000 or more. They watch their friends build wealth through their house while they regret. In finance, inaction is not neutral. It's a losing game. It's expensive. Time is one of your biggest enemy in finance. Let me leave you with this: everything is getting more expensive. But that doesn't mean you have to fall behind. Because once you understand inflation, economic cycles, financial psychology, and investing, you stop reacting and start positioning. The goal is not to beat the system overnight. The goal is to understand it and let time work in your favor. You can start slow, but the key is to start. If this video helped you understand why everything feels expensive, you're already ahead of most people. Because awareness is the first step to wealth building. Subscribe for more content on investing, stock market strategies, financial psychology, and long-term wealth. And remember, prices going up is not the end of the story. It's just the part that most people don't understand yet. Click like and subscribe. See you in the next video.